If you've been following the AI race casually, this probably sounds dramatic. ChatGPT still works. People still use it. OpenAI still has hundreds of millions of users. The company is still valued in the hundreds of billions. So why the panic? Because in technology, leadership is not about where you are, it's about where the momentum is pointing. And right now, momentum is no longer a one-way street flowing toward OpenAI. On paper, OpenAI looks unstoppable. ChatGPT launched in late 2022 and did something almost no consumer product has ever done. It rewired behavior globally in weeks. By some estimates, ChatGPT crossed 100 million users faster than any product in history, and today OpenAI reportedly serves hundreds of millions of weekly users. Revenue? Around $20 billion annually, depending on projections. Valuation? Roughly $500 billion in private markets. So again, why code red? Because Google woke up. For about a year after ChatGPT's release, Google looked stunned. Bard was rushed, awkward, and frankly embarrassing. It felt like a giant caught flat-footed by a startup. But Google doesn't lose wars quickly. It retreats, reorganizes, and comes back heavier. That comeback arrived with Gemini, and especially its latest iteration, which suddenly began outperforming ChatGPT on multiple industry benchmarks and, more importantly, user perception. When Salesforce CEO Mark Benioff, someone who had used ChatGPT for years, publicly said that 2 hours with Gemini was enough to switch, that wasn't a product review. That was a warning shot. Here's something Silicon Valley rarely says out loud: being first is dangerous. When you're second, you only need to win once. When you're first, you must win every single day. Every outage becomes a headline. Every delay feels like decline. Every competitor isn't just compared, it's framed as your replacement. OpenAI's greatest asset, its momentum, has quietly become its greatest liability. And unlike Google, OpenAI doesn't have infinite patience or infinite money. Google prints tens of billions in free cash flow every quarter. OpenAI burns cash. A lot of it. Let's talk about the number that truly scared investors. OpenAI has committed, directly or indirectly, to spending up to $1.4 trillion over the coming years on compute and infrastructure. That's not a typo. $1.4 trillion. To put that into perspective, that's roughly the annual GDP of countries like Spain or Australia. If you spent $1 million every single day, it would take nearly 4,000 years to burn through that amount. Stacked as $100 bills, it would rise far beyond the International Space Station. Meanwhile, OpenAI's revenue, even at $20 billion, is a rounding error compared to that commitment. This isn't just aggressive growth spending. This is existential leverage. And here's the brutal part: OpenAI is still not profitable. So when investors hear code red, they don't hear engineering sprint. They hear, what if this doesn't work? If this were a movie, this is the moment called The Empire Strikes Back. Google doesn't need to be better immediately. It just needs to be good enough, everywhere, by default. Gemini isn't just a model. It's an ecosystem weapon. Integrated into search. Embedded in Android. Woven into Gmail, Docs, and Workspace. Subsidized compute for developers. Free or near-free access for users. No launch day outages. This is classic platform warfare. Google doesn't have to convince users to download something new. Gemini simply shows up where users already are. And this is where the real fear sets in for OpenAI. If this story feels familiar, it should. In the mid-1990s, Netscape dominated the internet browser market. At its peak, it controlled over 80% of usage. People genuinely believed the browser was the operating system. Microsoft didn't beat Netscape by building a better browser. Microsoft beat Netscape by bundling Internet Explorer into Windows, removing friction, and making choice irrelevant. Users didn't defect because IE was better. They defected because it was already there. Today, OpenAI risks becoming the modern Netscape, technically impressive, culturally iconic, but strategically exposed. Because Apple controls iOS. Google controls Android and Search. Microsoft controls Windows and Office. OpenAI controls an app. And apps are optional. This is the part many casual observers miss. In mature tech wars, Performance improvements alone rarely decide the winner. Distribution does. Defaults do. Friction does. If AI becomes something like electricity, cheap, ubiquitous, and invisible, then user loyalty collapses. People won't care who is smartest. They'll care who is fastest, cheapest, and already integrated. And that's why OpenAI's Code Red memo reportedly freezes everything else. Ads? Delayed. Shopping agents? Paused. Health tools? Stopped. Personal assistant? Halted. Everything is sacrificed to defend one thing, ChatGPT's relevance. Because if ChatGPT stops feeling magical, the entire business model cracks. Strip away the hype, the benchmarks, the demos. The real question OpenAI is now racing to answer is simple: can a standalone AI company survive in a world where AI is becoming a built-in feature of operating systems? Because what's pulling this entire industry downward isn't Google, or Meta, or even Apple. It's commoditization. And commoditization is far more ruthless than competition. Every technology goes through the same emotional arc. At first, it's miraculous. Then it's impressive. Then it's expected. And finally, it's boring. AI is moving through that arc faster than anything we've ever seen. In 2023, people asked, can AI do this? In 2024, people asked, which AI does this better? In 2025, people are asking something far more dangerous: why am I paying for this? This is the moment where margins die. Because once intelligence becomes abundant, price, not brilliance, sets the ceiling. And that ceiling is collapsing. Here's a number most people missed, but Wall Street did not. In late 2025, some AI providers began offering API access at around $1 per million tokens. For context, GPT-4 class models had previously cost 2 to 5 times more. Earlier enterprise deployments assumed GPU rental costs of $4 to $8 per hour. Now, inference prices in some markets have fallen over 70% in under 2 years. That's not a discount. That's structural deflation. Once a low price exists, even if it's subsidized, it becomes a price anchor. Customers will never forget it. It doesn't matter if that provider is Chinese, American, or Martian. The market learns one thing only: AI can be cheap. From that moment on, expensive AI becomes a hard sell. This is where intuition fails. People assume the best model always wins. History says otherwise. Most businesses do not need genius-level reasoning. They need good enough summaries, decent translations, acceptable code suggestions, basic document analysis. For 80% of enterprise tasks, good enough. At 10% the cost beats best every time. Once that realization spreads, demand shifts violently. Fewer companies rent GPUs. More companies call APIs. More workloads move to hybrid or outsourced inference. Utilization rates drop across cloud providers. And when utilization drops, leverage kills you. Let's talk about GPUs. In 2023, NVIDIA H100s were unicorns. Rental prices reportedly hit $8 per hour in some markets. By late 2025, those same GPUs were renting for under $2 per hour in several data centers, a decline of roughly 75%. Why? Because everyone panic-ordered hardware at the same time. That hardware finally arrived, just as AI workloads got more efficient. This created what analysts now quietly call a hardware hangover. Too many GPUs. Too little profitable demand. Falling utilization. Rising debt servicing costs. And that's lethal for companies built on leverage. Now we get to the most uncomfortable part. A huge portion of AI growth isn't demand-driven. It's capital circulating. Here's the simplified loop. Big tech invests billions into an AI company. That investment is often paid as cloud credits, not cash. The AI company spends those credits on compute. That spend shows up as cloud revenue for the investor. Stock prices rise. More capital is raised. The loop repeats. Revenue rises. Cash flow does not. This is eerily similar to vendor financing during the dot-com bubble, when telecom companies borrowed money to buy Cisco equipment, inflating Cisco's revenue, until the telecoms collapsed. Cisco's stock fell nearly 90% after the bubble burst. The lesson wasn't that Cisco was useless. The lesson was that fake demand eventually reveals itself. In any leverage chain, the weakest balance sheet breaks first. In this cycle, that risk sits with highly leveraged GPU renters, cloud providers betting on permanent AI demand, AI companies burning cash faster than they monetize, and OpenAI sits uncomfortably close to the center of that web. Estimates suggest OpenAI could lose $14 billion in a single year if current trends continue. That's not a startup burn rate. That's a sovereign scale problem without sovereign backing. Strip away the hype, and OpenAI's future collapses into two realistic outcomes. Scenario 1, absorption. OpenAI is effectively absorbed by Microsoft. Not a dramatic acquisition headline, but a quiet, financial inevitability. Debt converts to equity. Independence fades. OpenAI becomes an internal AI division. Sam Altman becomes a senior executive, not a founder king. The technology lives on. The myth dies. This is the Netscape ending. Scenario 2, strategic bailout. If OpenAI becomes too important to fail, the US government steps in, explicitly or implicitly. OpenAI becomes a regulated AI infrastructure provider. A defense-adjacent contractor. A strategic national asset. Think Lockheed Martin, not Apple. Survival, yes. Freedom, no. Here's the cruelest twist in the story. OpenAI may have succeeded too well. By proving that intelligence can be scaled, replicated, and optimized, it helped turn AI into a commodity. And commodities do not reward pioneers. They reward distributors. They reward platforms. They reward whoever controls defaults. In that world, brilliance is table stakes. And survival depends on something far less romantic, positioning. The question is no longer whether OpenAI can build the smartest model. The question is whether any independent AI company can survive when intelligence becomes as cheap and invisible as water. History suggests the answer is unlikely. But history also loves exceptions. And that's why this moment matters.